Yes, it is very appropriate to be on here on Zoom with you, recording these before going into the interview with Eric.
If only we had our notes on Veeva.
Although I think it's a little bit out of our strike zone in terms of like perfect market. We would be the only podcasters in the world using Veeva.
Peter is very focused on clear and correct target markets.
Yes.
Who got the truth? Is it you? Is it you? Is it you? Who got the truth now? Is it you? Is it you? Is it you? Sit me down, say it straight. Another story on the way. Who got the truth?
Welcome to this special episode of Acquired, the podcast about great technology companies and the stories and playbooks behind them. I'm Ben Gilbert, and I'm the co-founder and managing director of Seattle-based Pioneer Square Labs and our venture fund, PSL Ventures.
And I'm David Rosenthal, and I am an angel investor based in San Francisco.
And we are your hosts. Today we have something very unique to share with you all. It is common for top venture capital firms in Silicon Valley to get all their CEOs together once a year in one room for a CEO summit and speak frankly with them. It is uncommon, however, to allow anything discussed to be shared publicly. Well, today we are doing just that. The good people at Emergence Capital, in particular friend of the show Jake Saper, invited David and I to interview two very heavy hitters at their CEO summit last week, Eric Yuan, the founder and CEO of Zoom, and Peter Gassner, the founder and CEO of Veeva Systems.
I think this is the first time that any content from any venture firm CEO summit has been specifically created for podcast public consumption. It's so cool.
I think Peter has never done a podcast before.
I think that's right.
And he's built a $20 billion company.
Yeah, the Veeva Systems story is amazing, as you will hear. We talk about they raised $4 million. That's four, like one after three. And on just that $4 million that they didn't even consume all of that capital, they've now built a $2 billion revenue business with incredible margins. It's such a cool story. And Peter is on the board of Zoom. And so as you'll hear, he and Eric know each other very well.
And it's a super different company that we normally talk about too. It's vertical specific, so it's just in the life sciences industry. They sell high dollar software to pharmaceutical companies and I think biotech as well, right, David?
Yep.
So the topic that we discussed with both of them is capital efficient growth. And that's something we felt would be super valuable for all the CEOs in the room. And obviously that means that we think it's going to be really great for everyone to be thinking about right now. So rapid scaling on very little capital is something they obviously both know a lot about. David mentioned the $4 million total funding that Veeva raised before going public. As you remember from our Zoom episode with board member Santi Subotovsky, also an Emergence Capital partner, Zoom raised $30 million from Emergence and another $100 million from Sequoia afterwards, and they never touched the vast majority, if not all, of those funds.
I think they didn't touch any of that $130 million. Eric had raised, as you'll hear about, he'd raised some money from angels along the way, and that funded product development, but none of the venture money was consumed.
It's crazy. So if you're excited to learn about how these companies managed to pull off enormous impact with very little capital to do so, you are in the right place. And if you want to discuss these topics with us after you listen, you should come join the rest of the Acquired community. I think we're 12,000 strong now, David, at acquired.fm/Slack. You should join us. It is always a riot.
This will be a great one to discuss in there with the community and other founders, and including Jake Saper himself from Emergence, who's active in the Slack.
It's true. As many of you know, we are excited that these special episodes are brought to you by the Solana Foundation as our presenting sponsor. Now, Solana is a global state machine and the world's most performant blockchain. What does that mean? It means developers can build applications with super low transaction fees, low latency, and not compromise composability, since it is all on a single chain with one global state. And many of you have heard this, Solana is capable of processing tens of thousands of smart contracts at once. Today, we are talking with Frank, the co-founder and CEO of Genesis Go. All right, Frank, welcome to Acquired. Thank you so much for being here. My first question, can you tell us what is Genesis Go?
Thanks so much for having me. Super excited to be here. So Genesis Go at its heart is an infrastructure project building primarily on the Solana blockchain. We've been bringing decentralized networks to a piece of the Solana network stack that's traditionally been very centralized. And by utilizing our native token, the shadow token, we effectively have been able to take very centralized network architecture, decentralize that in a way where anybody can step in, contribute compute power, storage power, and receive emissions in exchange for that. And what that's provided software developers on the Solana blockchain is the ability to get highly performant infrastructure at zero cost, thus lowering the barrier for entry for new developers wanting to come online and needing a stable platform to build on.
And how exactly are they able to get zero cost infrastructure, and how does the decentralization element play into it?
That's kind of like the magic of Web3. We took a page from all these NFT projects out there. We're issuing NFTs and basically used our NFT as a mechanism by which we decentralize our network. Whenever an NFT is traded, there's what's called an NFT royalty that gets paid, and that pays for our network architecture. And that's kind of like the backbone, right? The foundational aspect of it. But over time, as a network becomes more and more decentralized, the costs associated with running that network, right, the operational costs, are spread out further and further as more and more operators start to come online. And those operators, they carry those costs because they're earning emissions. It's very similar to if you think about like the Bitcoin network, right, the actual Bitcoin blockchain. People contribute compute, they're paying for the hardware and the electricity and everything in order to contribute that compute. But they're doing so because they believe that the emissions in the token, which in our case is in shadow tokens, they believe that those shadow token emissions are going to be more than enough to offset their own costs.
That's awesome. Frank, thank you so much.
Thank you very much.
Our thanks to Solana. If you are considering developing on Solana, head on over to solana.com/developers or click the link in the show notes. Now, as always, this is not investment advice. Please do your own research. David and I may hold positions in things we discuss on this show, and this is certainly not investment advice from anybody that we had on the show today. So now, on to our interview at the Emergence CEO Summit with Eric Yuan and Peter Gassner.
So to set the stage, I thought maybe could each of you please give us a brief overview of your fundraising history up to and including Veeva and Zoom's IPOs, which ordinarily that would take like an hour.
This is going to be pretty short.
This is going to be very short.
Private financing history.
Go ahead.
You go ahead, Peter. I was a simple angel investors when we just started, and then Emergence about 15 months in. So angel investors, I think that was 3 million, and Emergence was 4 million. We never actually used the Emergence 4 million, but I thought we might at the time, and we got to him within about 100,000 of using it, and then we went public. So that's the time frame. We started in 2007 in February, and we raised in about 2008, maybe March or so. So that was the environment at the time.
Another very simple time to be fundraising and company building in.
Yeah, it was hard to even open a bank account because it was the whole know your customer thing and financial crisis. So everything was hard. Yeah.
And I think probably most people here know this, but for folks listening on the podcast today, you're doing about $2 billion in revenue at Veeva.
Yeah. We're doing about $2 billion, about 30% profit or so.
Yeah. Amazing. Eric, could you share your fundraising journey with us?
Sure. I started a company in 2011. First thing I did, I opened up a Wells Fargo bank account. I thought it's very easy for me to raise capital. That's why I opened up a bank account. Unfortunately, it took me for several months. No VCs wanted to invest in me. Unfortunately, I do not know my brother Sandy and Emergence Capital. Otherwise, life would be much easier. And finally, talked to some friends and raised the 3 million seed funding. That's how we started. And when it comes to A round, I tried to talk to VC again, and again nobody wanted to invest us either. So we talked to friends and get another 6 million, and that's how we started. Yeah, it's very hard.
And nobody wanted to talk to you at that point because most people assumed video conferencing was either a settled frontier or a race to the bottom. Am I thinking about that right?
Absolutely right. That's a theme. Everyone mentioned, Eric, you are crazy. The world does not need to have another video conference solution. And another VC friend, even is his great friend, he told me that, Eric, I have a check for you as long as you do something else. Good news, I did not listen. I was very stubborn. I'll share with you a story. And once I was stopped by a big VC, I do not want to mention the name. For sure, you guys do not like them. And he told me that, Eric, I do not think your strategy works. Look at Skype, look at Google Hangout, look at WebEx, dominating, right? And I debated with him a little bit. I failed, and I cannot convince him. On the way back, I told myself, I'm going to change my Windows screensaver. Back then, I still use a Windows machine. I changed the Windows screensaver. You are wrong. So, for several years. Yeah.
And if just to make sure I have my facts straight, I believe you raised a $30 million round led by Emergence, and then another $100 million round after that. And similar to Peter, you did not dip into any of that $130 million. Is that correct? To build the business?
For me, actually, after the $30 million, from Emergence Capital, I think, we are on the right track. To be honest with you, actually, we even do not need to raise a Series D, actually, because at that time, I think with that $30 million, I think the company is completely into I feel like a different game. So, yeah.
Wow.
That's one thing we wanted to ask, is a difference between your two companies. Peter, you obviously, once you got to cash flow profitability, which was immediately, basically, you never raised another round. Eric, you did make the decision to raise some more capital even after you were generating cash. And Peter, you were on Eric's board when that process happened. Why did you make that decision?
Well, for Veeva, I didn't raise more just because I thought I don't need it. It's just that simple, right? So, and then as far as for Eric, right, when you're on the board, right, that's really Eric's decision. So,
So, yeah, as I mentioned earlier, right, after we raised $30 million from Emergence Capital, at that time, seriously, we had no plan whatsoever to raise another round of capital. And the reason why we still move forward to have a Series D is because I thought the economy will go down dramatically. So,
This was 2017?
16, 17 timeframe. I was completely wrong. So, but anyway. So,
It had been the 7-year bull run. Of course, the end was near, right?
yeah. So, and long story, but anyway. So,
yeah, I think that raising that money at the time, I thought, yeah, maybe we don't need to do it. But also, I thought it doesn't matter, right? What matters for Zoom is the great product and the customers. Whether you take some more money, you don't take some more money, right? It's all fine. It would all work out.
that's right. Yeah.
So as we were preparing for this interview, our first thought was if we just had one of you up here and we were interviewing you about capital efficiency, it'd be easy to chalk it up to business model and cash flow cycle. Multi-million-dollar contracts up front on, in the case of Veeva, or in Zoom, customers flocking with their credit cards for a self-serve experience. These are two completely different models. And so I think one of the things that it illustrated to David and I is capital efficiency is a mindset and culture thing more than a business model thing. And I'm curious to hear both of your reactions to that, but also what are the things that enabled you uniquely, more so than 99% of startups, to be so capital efficient?
Well, I can take that one. I guess I've seen a little bit of Zoom and a little bit of Veeva. I would say probably it starts with a mindset, just run a profitable lemonade stand. From my point of view, for me, it was there's safety in that. Cash generating business is always going to be valuable to somebody. At some point, a business that's not cash generating is going to be valuable to nobody, right? You might be able to sell it before it becomes not valuable, but you can there's security in long term. So it starts with a mindset. I think Eric shared that. And then you have to have product excellence too, right? And that's something I think Eric and I share. We're both product people. I think also we both worked really hard. We work really hard now. I think especially Eric, probably in the first 5 years, I worked really hard, and you didn't see me working really hard, but I saw you working really hard. So worked really hard, worked really focused. Anything that wasn't related to the product or the customer was just BS, and just don't do it. Like first 5 years, I was not at a conference like this, for example, right? I was just maniacally focused. And then the market really helps too. And that's something you just have to get lucky on, right? It was the right timing for Veeva. It was the right timing for Zoom. Maybe if you started Zoom 5 years earlier or 5 years later, it would have been hard. So product excellence, real focus, mindset, and then you have to have some luck in your market. I'm sure there are some things that I could have tried to do or Eric could have tried to do, and we might have picked a bad market, and then it just wouldn't work. And that's, I think you have to, so we're an outlier, right? And so is Eric. You have to pick something that most people think is going to fail to be an outlier. Otherwise, by definition, you're picking something that most people think is going to work, and therefore a lot of people are picking it, therefore you're not an outlier. So just like Eric, most VCs, all VCs, except for Emergence, all VCs of any kind of note, except for Emergence, turned us down, right? And ours was really simple. Vertical specific software, that's a small market and it doesn't work, right? That's what they would say. And I was encouraged by that because I thought, well, it has an opportunity to be really good because it's something non-obvious.
Well, one thing that I want to double click on that we were talking about beforehand, yes, like you need to be non-obvious to have a chance of a great outlier outcome, but you also need to be correct. Mm-hmm. But I think what you both did was not, hey, I'm going to pick some random idea that other people think is crazy. I know Veeva has as one of your core values, clear and correct target markets that you have like written on the wall. What did each of you do, ahead of time that led to you to like really genuinely believe, yes, the world thinks this is crazy, but I really think this is going to work?
I'll go first. It's real easy. I talked to 3 or 4 potential customers for our first product, and they all said, we don't need that. That's not interesting. It's not a good thing to do. But I wasn't listening for that. I was listening, are they emotionally attached to where they're getting their product now? Are they emotionally attached to those people? Do I feel like they're getting value out of that thing? And I could tell in their responses that they weren't attached and they weren't getting value. So yeah, all 4 customers said it's a bad idea.
All right, so
they're all customers now, though.
Let me understand the Peter formula to build a business. Ask a customer if they want your product. They say no. You dig deeper and say, what are you using now? And they say, yeah, because I have a solution for this, but they just don't love it. So you build for them anyway on the bet that you can be better than their current thing.
Yeah, you have to listen to what they feel, not what they say. They would say, yes, we're very happy with this solution. But then you dig, tell me more. Why is that? What is it that you get out of it? And it's like, and that's when you know.
That sounds like the video conferencing market circa about 2015, 2016.
Yeah, so for me, it's very straightforward because I was a regional founding team member of WebEx. So the 2 years before I started a company, I know actually, WebEx really sucks, right? So, and
did you try and tell Cisco that?
I tell my team. I do not dare to tell others. So, but anyway, so Skype also not reliable, right? Google Hangout does not work. Every day I spend a lot of time talking with every customer. I know if I can build a better solution, I think at least I can survive. I never thought about everyone is going to standardize on Zoom platform. But at least I know for sure is if a customer, they do not like something, if you can build something better, you have a chance.
Yeah. Eric, did you think from the outset that you were trying to build Zoom as a big company, or did you just think that you wanted to build a profitable company to survive, and then you would sort of see where it went from there?
I think 2 things. First of all, at that time, my passion was very straightforward because, WebEx is more like my baby, right? I feel like I worked so hard for so many years. I let the customer down. I really wanted to fix that problem, but Cisco did not want me to start over, and I had no choice, but to leave to build a Zoom. That's the number 1 reason. And after I started the company, I realized, wow, it's so hard to raise capital, right? And by the way, the money that they give to you, don't think about that's money. That's a trust. Every dollar matters, right? That's why every day I was thinking about how to survive. Even today, seriously, I still think about, I woke up at night, how to survive. So,
you mentioned, people in your team. When you started Zoom, you were a solo founder, but you brought a large number of people with you. One of the kind of first sort of operational topics we wanted to dig into around this topic of capital efficient growth is hiring and people. That feels like such an important part of the culture and DNA of having people who are going to get on board with, there's not going to be, the spiritual equivalent of kind bars and, exposed brick in our office here. How did you select for, maybe both of you, but Eric to start, because you brought so many people with you from WebEx. How did you select for the people that you brought?
So all of them are very good engineers, right? Except for me. So I did not write any code. So, and on day one we had around 25. Very soon we get another 15, total 40 people, and myself included. All the 39 people, they all write all kinds of code.
And this was all funded with angel money.
Yes, exactly. Wow. But probably, I know actually, we can, with run rate probably only less than 2 years, right? That's why later on we had a Series A. But we only have engineers just get the product done. And I'm more like a product manager, UI designer, and also the facility guy, everything else. Seriously, on day one, I bought use the furniture, assemble everything by myself, and also write down the company culture and value. That's pretty much what I did. So I would say and even for the first several years, after product ready, and some investor mentioned, hey, you already have money in the bank now, why not build a marketing team? Look at your competitors, they spend a lot of money in all the billboard and one-on-one. At that time, I think no. For the first 4 years, we do not have any marketing team. Only until 2015, we started building up our marketing team. So
I just want to make sure we
have to be very disciplined. Yeah.
To just highlight this, so you started the company with 25, quickly growing to 40 people. But those were 39 engineers and you. No product managers, no marketing, no sales.
Yeah. That's the reason why I know how to use QuickBooks. I never know how to use that. So seriously, I had to learn how to use that. And
So it sounds very easy to say, don't buy billboards. You got to get your customers somehow. How did you get the Snowball going?
A little bit lucky, because seriously, and luck does play a role, because the several weeks before we launched the product, seriously, we had no idea how to get a first customer. Luckily, and the very famous, the reporter, the Walter Mossberg, right? He evaluated our service, and we were so nervous. He's very straightforward, right? And the good news, he did write down a very nice article published in Wall Street Journal, and also he personally recorded a video, and over the night, we got 50,000.
50,000 users from that article.
Wow.
Yeah. But most of them, they left, after the several weeks.
But those who stayed, I imagine that was the kernel of the virality of telling their friends who told their friends who told their friends.
I maintain a very good personal relationship with them, either VIP account or send them a small gift. And someone they canceled, back then only $9.99. I personally sent them an email. Why you cancel our service? What we can do differently? And we still maintain a relationship even today. So.
We had one of the CEOs wrote in and asked us about different metrics to track. Did you have a North Star after you had those 50,000 people where you realized, okay, I'm holding something in my hand and the sand could slip through my fingers, but is there something I can measure to see if this 50,000 can turn into something? What were you paying attention to? To those very early, very loyal early adopters. Yeah.
Even 100 is good enough. They are the early, I would say is the most loyal users. Double down to make sure they are happy. If they are very happy, guess what? Network effects. They are going to bring a lot of new users. So that's why even 49,000 users left. As long as 100 still stayed, we double down on that. So that's a strategy back then. Yeah.
For Peter, on the hiring and people and organizational front, you had a very, very different type of business. Your customers don't buy with credit cards.
Right.
They buy multi-million-dollar deals, cash up front in a year for a year deal. You need a sales force to sell that, which usually means you need a lot of cash comp to compensate that sales force.
Right.
How did you think about the right people to hire as you were building, and how to compensate them?
Yeah, I think one thing Eric and I have in common are, in the early days, there's no wasted people, like no optional people, no wasted people, because it just adds, it'll burn through your money, and it'll just make your decision making smaller and, more complicated. It's like sand in the machine, so no wasted people. And for us, we needed, because a long sales cycle, so we needed sales right away, right? So I was the first salesperson, right? I started selling before I signed the articles of incorporation. Show up at the customer, hey, I think you should buy something from me, this thing that I'm going to make. Well, have you hired anybody? No. Well, okay, can you show us a demo you're going to do? No. How about a PowerPoint? No. Okay, and then come back a month later. I got a PowerPoint now. Have you hired anybody? No, not yet. And then just keep selling, because it's a relationship-based business. Funny story, the first customer who bought, small customer, we actually somehow, through a relationship with my co-founder, we got to this guy, he was the CEO. He wanted to buy some software for this small department just because he was really peeved with his IT team. So this guy had no idea what we're selling. He's like, I know that my IT team doesn't want you, so I'm going to make a point and show them that I'm actually in charge here. So that's how we got our first sale. And you could barely log into the system at that time.
Could you? That's amazing. I didn't know that.
But then you got to hustle, right? Then just like Eric, right? Then you got to hustle. Oh my God, this customer wants to buy something, and then you're working super hard to make them successful. And Eric, I'm not sure, I never asked you about this, but we never had customer satisfaction surveys for Veeva in the beginning. I always thought, if I talk to those early adopter people, I will get the feeling. And if I have some survey, maybe I won't get the feeling.
Totally, you're right. I agree with you.
You can hide behind, when it's small, you can sort of hide behind metrics sometimes, and it doesn't work. But if you actually talk to the human and you figure it out, you'll know what's going on.
How can you tell us also the story of landing your first big customer?
The big customers.
Which I believe is probably the deal that really made the business.
Yeah. There was a set, right? There was the guy who was just peeved at his IT team, and then worked up to the next size deal and the next size deal, and it was always a step function, right? And so the first multi-million-dollar annual deals were a big customer, Pfizer, and it was just hand-to-hand combat. There was a partner at the time, actually, Salesforce.com actually at the time said, send a note that Veeva will never win this deal. And I replied back, I said, we will win this deal. And
they sent it to you during the bake-off.
Yeah, they didn't want to even come into the meeting with us, right? They were like, we're going to go with this other system integrator or something like that. So I sent an email back and said, we will win this deal. Why? Because we have better people that'll work harder, and we're Pfizer's only shot at greatness, and I think they want to shoot for greatness. And so, and I remember there was this big meeting with Pfizer. There was a guy in there in charge of it, and we had a certain amount of people in the meeting, and the guy stood up for Pfizer. He said, we have more people in this meeting room than you have in your company. Why should we buy anything from you? And I just said the same thing. We're your only shot. We're going to make something great, and we have the best people. So it seems simple to me. And then we got lucky, and we won it. And then I remember after winning it thinking, oh my God, now what? Now how are we going to make them successful? So the whole company got a bonus when that customer was what we called live and happy, which didn't have a formulaic metric. It was based on interviews.
So did you use the invoice from that customer to then go fund product development?
Yeah. I thought, we've just raised a $3 million round of capital here, and it didn't cost us any dilution, right? The check came in. So that's exactly what happened. Yeah.
Do you think that's still doable today? Like, I imagine there's lots of folks out there that are like, well, I would love to go invoice a customer and get cash in the bank. And what situations is it possible to fund your product with customer revenue versus not?
I think first of all, you can't be wasteful. Every person has to matter. I would almost think about, we're hiring that person. Let's say we have to pay them $100,000 a year. My father was in the business of metalworking and machinery. And I remember him, he would like, oh, I got to buy that lathe. How much is that lathe going to cost? Is it worth it? So I would think of people like, I'm buying $1 million machine because I got to pay him $100,000 a year. Is that $1 million machine worth it or not? So frugal, and then make a really excellent product, because that's the best way you can lower your cost of sales. So like Eric's product, you probably all notice it, that it's easy to use, but he made it easy to consume, the whole product. So he didn't have to convince a bunch of people. So that's how to do it. Excellent product, get a good price, easy to consume. You don't have to spend your money on salespeople because you have a differentiated product. Because salespeople, that's where it's really, really expensive. Right. You didn't have any salespeople.
When I read the Peter's the S1 document many years ago, at that time I still remember, wow, my God, this business model is so awesome. But in our case, our first paid customer, largest paid customer, only $2,000 a year. So we cannot use that to fund the new product development. Because most of users pay us only for $9.99 a month, right? So that's really hard. But I do think, for all the founders, right, the business model very, very, very important, right? If you can figure out a way to do something similar as what Peter and Veeva does, that's the best. Do spend time on that. Right, not only for product, but also the business model, right? As Peter mentioned, product excellence and how to sell the product, and how to leverage a big enterprise customer, as is very important. Build a long-term sustainable company. In our case, actually, I can tell you today the biggest challenge is our online business. Right? It's very profitable. However, it's very hard to predict. Right? They come today, next 2 months they might leave, they cancel the service. This is not a great business. But enterprise portion is very good. That's why I learned a lot from Peter, how to manage a big enterprise customer.
We met at an Emergence event way back when. That's how we first met, Eric and I.
Yeah, wow.
It was smaller at that time.
Hopefully there'll be some more connections like that today. Yeah. One thing I want to highlight on this topic of contracts and funding development, because I think it's really counterintuitive. Again, the topic is capital efficient growth. You would think that what you would want to do with the, that Pfizer deal, for example, or Eric, when you started selling enterprise contracts, is multi-year deals. Let's make this contract number as big as possible. Let's get as much cash up front. Let's lock people in for 2, 3, 4 years. That's not what you did at all, right?
Yeah, we didn't do that because I was always optimizing for the long-term value, which is the annual value per customer. So if I had to give the customer terms that would lock them in, I thought that's actually shrinking my market because they'll pay less if they're locked in. That's one thing. Then the other one, I didn't want us sort of getting lazy. I wanted us to earn the business every year. So it was just sort of like that. The driver was really optimizing to the long-term value.
Yeah, which is, it makes so much sense now thinking about it that you would have had to have given 30% annual discount or lock in the price, then raising prices is harder later.
And that's unique to us. I think we're selling in a very confined vertical. So it's not really fair if there's two companies and one's paying 30% less than the other, and they end up knowing about it and feeling bad about it. So that's something specific to this confined market.
And to put some shape around it for folks that don't know Veeva's business as well, you've a couple thousand customers, of which there's 100 or so that are your like really big customers.
Yeah.
And there's basically no one else out there who could be a customer without you expanding the market.
Right. We sell into a defined set of customers. Life sciences industry, there's kind of top 20, and then there's another 1,000 or so that are doing smaller things, and we've just expanded our product footprint. So when we sell to a customer, we might have 20 things that we can sell to them. They start in this area, they start in that area. So Gordon calls it layering the cake, right? We have a lot of different layers to the cake that are all into the same customer. We leverage relationships. It's fine for us to spend $100,000 a year maintaining free relationships. Mm-hmm. Just putting into developing relationships. That's not wasteful. So because we have we're showing up the door with $100 million worth of product. Right. So if you have a relationship, it's worth it. Like a bank, investment banking, it's worth it to invest. So it's a different type of business.
For our second sponsor, just a company that is so special to us in the community, Mystery. I think at this point, probably everybody listening knows about Mystery and their story, but we've had these guys on the LP show back in the day. They've pivoted twice. It's been this incredible journey, and they have landed on something that is it's just frankly incredible to watch.
And we know for a fact that a lot of the acquired community took the Mystery folks up on their last offer from the last episode. So we were excited to share more details on that, but certainly many more of you are familiar with Mystery than were even a couple months ago.
I know. It's so cool. So when Mystery had originally started as a consumer-facing magical recommendation platform to take care of a night out for you and your significant other or your friends, make it magical. You don't have to do any planning. COVID hit. That obviously was not a great business to be in during COVID. They pivoted to doing virtual and remote teams and office culture. And man, God, those Zoom happy hours that teams were doing and companies were doing were just terrible.
I'm glad we're through that.
Oh, I'm glad we're through that. And I'm glad we have Mystery because they take all of that over for your company. It's crazy. They work with Amazon, Microsoft, Apple, McKinsey, Uber, Twitter, Autodesk. All of these companies use Mystery to completely take over the planning, the organizing, running all of the team experiences for their internal teams, oftentimes also for external facing customer events with their partners. And it is way, way, way better than the Zoom happy hours.
Yeah, not only do you have to not do the work that you would have had to do to plan it before, but they're just way better too, because the Mystery team, I know there's a bunch of former wedding event planners.
And they get amazing performers. It's super cool. And this is what's cool, what they've built out. Obviously there's this, events aspect. They've built out the software side of this too. So Mystery now tracks employee engagement and customer and partner engagement, participant engagement with your events and the impact on employee satisfaction, retention afterwards. Before Mystery, 90+% of a company's morale budget was frankly misspent. And the reason why was there was no way to track whether, going go-karting with your team or anything actually had any impact or moved the needle. Mystery solves all of that, not by not only taking care of the events, but then giving you full insights into what the actual impact was on your team and on your employees. So they have, today executed thousands and thousands of these events. This scales up and down as big or small as you want. Modern Treasury uses them. Convoy uses them. So many other friends of the show. Mystery just raised a giant Series A from Greylock to blow everything out further.
Yeah, and for listeners, in case you missed it on the last episode, they have the greatest deal ever offered to the acquired audience. I looked it up and I was trying to do some quick math to figure out, has anyone ever discounted this well or offered this great of a free, early experience? No. So Mystery is giving you 3 mysteries for the price of 1, which means that the first event is just $25 per person, regardless of the team size, and the next 2 are free. And of course, because Mystery is Mystery, and this is what they do, they sort of learn from that first event about you and your team and get tighter on how to tailor the next 2 experiences to sort of build on that and be even better. So you should totally click the link in the show notes and take them up on this screaming deal to try this out with your team. That is trymystery.com/acquired for 3 mysteries for the price of 1.
Super great. Thank you, Mystery.
Thanks, Mystery.
Eric, for you, I'm curious, maybe you can talk to us both in the beginning days and then also now at Zoom. How do you think about pricing and account strategy?
Yeah, so, in our case, it's a little bit different. Ideally, when you start a SaaS company, either focus on vertical market or focus on departments. That's probably the best business model. Unfortunately, you start from building up a horizontal collaboration solution is really hard, right? Because a lot of other competitors are already there, right? So our strategy,
including free competitors,
exactly, a lot of free solutions. So our strategy, more like you open up a new restaurant business, right? So and you have a better service, right, and a better price and a better food. That's pretty much even today. We want to make sure our product is better than our competitors. Make sure when it comes to pricing, also better. And they also make sure, offer the better service. So you look at any time, our product always at better price, across the board, any product compared with any competitors.
So life is about trade-offs, and if you're telling a customer, oh, we're better, faster, and cheaper, what has to give? Is it something organizationally? Is there something? Efficiency.
Yeah, exactly. See, like a customer, they are probably going to spend a lot of money on marketing. What we can do to leverage the network effects, right? They hire like a 100 sales rep. What we can do to have a 50 sales rep, can deliver same value, right? So that's why it's very important to have, internal, the efficiency. Yeah.
Which is, so funny that efficiency translates to capital efficiency, which translates to gross margin, or not gross, to operational margins, which translates to cash flow,
totally,
which is the whole point.
Yeah, give you more flexibility, right? Yeah.
Yeah.
But I would say the key also is just the product excellence, right?
Yeah,
and
totally.
that comes from the core set of engineers you hired, I think, and then also you were especially very focused in the early days, right?
Totally.
You are not thinking about something else, right?
Absolutely.
You were thinking about video conferencing, and I would say, that's why I got to know Eric. I got to know Eric. I thought, that's a pretty focused guy. I bet his product is good. And then I tried out his product. Like, oh, this is really good. I want to join his board. So I think that's so is the product excellence can make you more efficient. Your sales cycle's more efficient. Everything's better. If your product was twice as good as WebEx, right? If your product was only
10 times better.
10 times better. But I guess my point is, if your product was only 20% better, it wouldn't have been enough. It wouldn't have mattered.
You're also right. That's why I always like this restaurant analogy, right? You stop by in a restaurant, a brand new restaurant, it's food that does not work. Even for free, you do not want to stop by it, right, anymore, right? So, again, I think back to Peter's point, it's extremely important. Right? Everything starts from one thing, the product. Product excellence, that's a foundation. You can optimize a lot of things. If a product does not work, forget it. Everything else, just double down, triple down on product. That's the number one thing. Peter right on.
And that's a lot about people, right, Eric? About which people you put on the product.
Yes, totally.
Eric was very particular about getting the best people.
So people, we come back to that. I remember when we talked about with Santi on the episode we did on Zoom's IPO years ago now. Your named executive officers in your S1 were not like you think typical, oh, here's high-flying SaaS company. There's going to be a VP of sales from Salesforce. There's going to be a chief marketing officer from HubSpot, whatever. And nothing wrong with those companies and those people. But I think at both of your companies, the people you brought in as leaders were up-and-comers. They weren't, the established superstars.
Yeah, I think I always wanted to have some people with some range. They could get very hands-on, but also grow into managing. I guess I've always thought to try to get people to do something that they haven't done before, so they would have a little bit more mojo, have an opportunity to do something that they haven't done before. And the team is very important. The chemistry of the team is much more important than the skills of the individual players.
In a lot of ways, that comment reminds me, there's a parallel between you not signing multi-year deals where you're forcing the product to earn the customers, and you promoting internally where you're keeping people hungry and forcing them to do their best work to earn that job.
Well, it's more thrilling when you can give somebody a chance to do something that they haven't done before, for me and for them. There's more fulfillment. Otherwise, it's why you're doing the same thing you've done 3 times, and what's the allure? Well, I can get rich. Okay, just at some point, that doesn't keep you going at the end of the day.
Would also I imagine there's an element of compensation to this strategy too, which translates to capital efficiency.
No, not really, no.
I always think of equity versus cash, but...
I don't think so. I never really made any kind of decision on people based on that. You got to get the right person, and then pay the right compensation for the right person. But always the right person first, and then figure out the compensation.
Peter right on. Actually, back then when we we tried to make an offer, right, to some executives, right? At that time, the feedback, why not hire someone very experienced and seasoned leaders from outside? It's really not about a comp package, because, when it comes to hiring, at Zoom, we really like to hire those people with a self-motivation and a self-learning mentality, right? Including the senior executives. And they can grow themselves along with the company growth. And plus, they are very loyal. I think that was our philosophy. I thought that's the best philosophy. After the COVID, I think I was wrong, actually. There's a bigger flaw also. Because when business auto grows your team, and guess what? The executives or team, they are not ready. Like usage 15 times, 20 times more. The revenue 7 times more. Our team, even not myself included, even not twice better. This is one challenge I learned. That's a mistake. Another mistake is we think all those executives or key team members, they can learn along with the company growth. However, the pace is different, right? Someone can learn quickly, someone very slow, right? That's why also that's another flaw, right? That's why looking back, I feel like, we should have a mixed, team structure, right? Someone, they have a potential, they can grow themselves. Someone else, you have to hire some seasoned leaders. You never know, right? In case suddenly your business is going to take off. At that time, your team not ready. That's a challenge we are facing today.
So you need to have some members of the team who have experienced scale bigger than your company, but other people that you're developing.
Exactly. That's a healthy mix. Back then, prior to pandemic, I think too stubborn. I should learn more from Peter. I think everyone, you have to have a potential. You do not need to have a great background. Actually, looking back, that's not right.
Interesting.
Maybe a mix would be better.
Mix is much better.
Do you think that applies do you think you should have done that even in the early stages of the company?
Not early stage, right? For the first 4 years, no need. But down the road, you already see the market fit, right? The product fit. You want to scale your business. At that time, you have to change your philosophy.
Yeah. There's another, these parallels keep popping up for me where Zoom is one of the greatest product-led growth companies of all time. And yet here you are talking about the beauty of predictable revenue that comes from enterprise contracts. And it's the same thing. It's not that experienced people are better or that in-house talent is better. It's that you need that mix.
Totally. Yeah. The healthy mix is very important. Yeah.
So the last, one of the last sort of disciplines within a software company that I want to talk about operationally in this context is marketing, with both of you, but particularly with Eric. When we were chatting with Santi and with Peter, we sort of asked this question. We're like, you scaled, once you had the product developed, you scaled with such beautiful capital efficiency, but you did spend money on marketing. I mean, you joked about the billboards, but there are Zoom billboards now. And I asked them, how did Eric and Zoom think about spending money on marketing? Well, I'll let you tell the punchline, but how did you think about it?
Yeah, that's even today, every Tuesday, we have a 3 hours, staff meeting, right? This morning, the first topic read about reviewing our top 10 marketing programs. Even today, still, I think it's very tricky. The reason why is you do not have, I would say, is a sort of like a formula, right? When to spend more, when to spend less. It's not like that. As a founder, you have to spend time on marketing as well. Do not always focus on product or the sales. Marketing also is very important, right? However, when to invest in marketing is very tricky. Every business is different. In our case, we specifically, made a decision. No marketing team for the first several years. Because this is not something new, right? It is a product, or this is very, very mature market. Everyone understands video conferencing. If your product works, you really don't need to have a marketing team, right? We try to prove that point. After that, after we have a paid customer, a lot of customers, the customer told us, Eric, I never heard about Zoom, but I tried a product, the product works, right? Why is that? We received a very consistent feedback like that. I know that's a signal, right? Then we double down on that. Then 2015, we created a marketing team. And also, even after that, we also measure every marketing program spending. Early on, I spent a lot of time trying to understand. I'll give one example, like SEM, right? Every company, you spend money on SEM. First time I sent a check, oh my God, this is the price of paid to Google. Oh my God, this is the largest check I'm going to sign.
Do you remember how large that check was for context?
That's more than 200,000 a month.
A month? Oh my goodness.
Yeah, it's crazy. That's why I wanted to deep dive to understand. But by the way, marketing team is all very well educated by Google, right? In more like talk about ROI. You give me $1, I give $1.50 back. It's
Let's
right?
do
It's
that.
pretty cool, right?
Yeah.
But I tell them, no, you should have $3 back. Why $1.25?
Well, I particularly want to ask you about
exactly,
the
they spend
time
a
frame
lot
you
of
wanted
time.
that money back.
How to optimize that, right? And again, marketing team very important, but quite often very creative, right? If you do not know how to measure that, do not spend. That's
The stories we heard were, most founders, CEOs, marketing teams think about CAC to LTV with marketing, and there's more complexity to it than that, but I'm going to spend $1, I'll get $1.50, or I'll get $3 back. If that pays back within a year, I'm doing great.
Don't believe that. That's a mistake for all the SaaS companies. It's not $1.50 back, not $3. It should be $4, right? It should optimize.
Just went up in the last minute.
Yeah. But that's a common mistake, I think, for most of the SaaS companies.
And Eric, how fast should it pay back?
As I would say, it's as big as possible, right? Every business is different, but you got to optimize. Keep optimize every day. Do not feel satisfied. Oh, give $1, get $1.50 back. No, optimize. Got to get $2, $3, right? You have to optimize. This is one example, right? For every marketing dollars. However, if it works, you have to double down. I remember, first time I had the billboard in 101. Many customers shared very positive feedback with us. They feel like, early on, we decided to deploy Zoom. I saw the billboard. I feel like you guys are a bigger company. We made the right decision, right? To bet on Zoom.
It was more about validating the decision than...
Exactly. And plus, the employees, they feel very happy, right? They say, oh my God, Zoom has a billboard now. After that, I realized, why not double down on that? I told our team, how many billboards we have in 101? This is 1. I said, no, 3. It works. Yeah. So that's why you have to know when to double down, when to take a step back. If you know how to effectively measure that, that's very important.
Well, we spent most of today talking about how to build the castle and how to have a profitable castle. Not sure if that really extends, but now let's talk about the defending the castle. I'm curious. Maybe let's start with Eric and then go to Peter, since we've been on a good Zoom streak. Where do you see the source of Zoom's defensibility as a business over the next 30 years?
Yeah, so, I think it's more like a sports, right? We need to focus on both offense and defense, right? So both sides, right? So I think back to the Peter point, you still need to, even your product works today, even better than any other competitor, you have to be paranoid, right? You have to keep thinking about what you can do differently. Keep innovating, either the new services or new features, right? That's the most important thing, right? By doing that, at the same time, you also need to think about what's next, right? From our perspective, right? We started from a unified communication. The next step will be, not a unified communication, it's collaboration platform, right? At the same time, how to build multiple new departmental applications. You also need to play offensive as well. Mm-hmm. The better offensive play is probably is for the defense as well, right? So that's our strategy. Yeah.
Mm-hmm. Peter?
I'm very similar. So product excellence is you can get there, but you also got to work hard to stay there, right? And keep reinventing yourself. Also, you do want to expand to different areas, because if critically, and I think something that people don't realize, if you get a high market share in an area and you don't expand to another area, what will happen, just because of the nature of your company and the creative people, you'll do more stuff in your established area than you should, right? And that creates its own set of problems. If you do more stuff, and if Eric is constantly rewriting his codec unnecessarily, right? It's disruptive. So you got to expand to give yourself a creative outlet. And then this may be more particular to us, I don't know, but we also have a goal that we set out about 5 years ago to be the leader in light. That was our code name for it. Because if you get to be quite dominant, arrogance is there's a few things that will knock you off. arrogance, the customers will get turned off over that, and they'll naturally find an escape hatch. Also, we audit for integrity of the leadership team, because when you're quite well established, that can throw you off. Integrity issues in the leadership team, so we audit myself and others, and also energy in the leadership team, because these are things that you got to audit for them. Because if you wait for the results to show those things, it's too late. So, determined to have product excellence, have a goal to be the leader and liked. We actually tell our customers about that, and that holds us to a higher standard. So we want to be the leader and liked, and then they bring that up sometimes, like, hey, that's not the leader and liked. Oh God, why did I tell you that? But I mean, it's a way to set yourself out there, right? Not only do we want to be the leader, we want to be liked. Product innovation as an outlet, and then avoid that arrogance.
You talked about.
But by the way, I think related to this question, I want to share with you a conversation I had with Peter. I think probably can help some of the founders here as well. I think I forgot which quarter, a year before we went public, and I look at our growth plan. I realized, wow, we wouldn't have one service, right? If we have another service, also can monetize. The growth trajectory will be very different. At that time, Peter told me that, Eric, that's sort of like the ideal case. But that decision should be made 2 years ago or 3 years ago, right? If you wanted to have a new service, you cannot have a new service today, right? You need to think about, trying to make a decision 2 or 3 years, before that, right? I clearly remember that conversation. That's looking back, that's the biggest mistake. The reason why, because you have one service. At the same time, how to think about what's the next service, right? Always plan ahead, right? This is probably the better way, right? Back to your question, always think ahead and build another service. So
That's exactly what I was going to ask as a follow-up. Peter, I know Veeva launched a second service after the first CRM service around content, CMS, content management. When did you start planning for that second product, and then when did you launch it relative to your first product?
We started thinking about it at the first part of 2010. I remember Gordon and I and others started thinking about it at the first part of 2010. So we had 150 people in the company or something like that.
That was 4 years into the company, 3-4 years
so
into
3.5, yeah. And then we made our first hire in the fall of 2010, and that's when we started going. So I viewed that as critical. It was a turning point. I thought, hey, I could have a single product company, do really well of that, maybe go public, but then it probably has to be sold to somebody or something like that, or I can try to make it a multi-product company. And the decision was to pick something that was clearly not an add-on to our first product. Like, it was clearly so far away from our first product. I was worried that our second product would maybe become an add-on to our first product. And so I just picked something that was just way out here, just way, way different. Sold into the same company, but different buyer, different product, different code line, different everything. So I thought, this is the way to become a multi-product company, and it'll either make us or it'll break us. And I thought the odds were more likely that it was going to sink us.
That's so counterintuitive, because normally you would think you'd want to give the same sales rep something that they could sort of bundle in for an incrementally higher ticket price and leverage what assets you already have.
But that you will do anyway. Like, if you don't go out of business, gravity will take you there, right? It's as you go along, it's like, oh, well, maybe we should make an add-on product or not. Like, yeah, duh, But if you get confused, and you think that add-on product is really going to float your boat, it's not. Your new product, if you have a chance, it should be way out here and maybe have the potential to be bigger. So but it's risky.
What's the scale of the two revenue lines today?
The second one is a bit bigger, but the second one has also quite a bit more potential. Maybe it's a 5x or 10x potential.
Wow.
But it was risky, right? We debated that at the board level, because that could have sunk the company, because our rocket ship on our first product was going up, and I had to take my eye off that ball to start this thing, and it did cause that first thing to suffer. But overall, the trade-off was worth it. But it could have worked. It was risky.
Our most recent episode was about NVIDIA, which had a tiger by the tail with gaming, as everyone knows. They totally took their eye off that ball to start building for life sciences, for scientific computing, for what became neural networks and machine learning. And boy, was it a good thing they took their eye off that ball.
The hidden thing there you need a CEO that was engineering type that went to Oregon State University. Because that's what NVIDIA and Veeva have in common. I don't know him, but we both, there are very few of us Oregon State Beavers as CEOs, let me tell you.
That's amazing comedy. I know Jensen well, actually. Look at NVIDIA stock price. It was flat 10 years in a row before they took off.
It's such an amazing story. I mean, the conviction, really, he had to persevere through that decade is amazing.
It's certainly
hard work, right? He's a hard worker.
Yeah, he's very hard
worker. That's
he
also,
is focused.
Yeah, there's no. I remember when starting Veeva, the first time I started a company, I asked a friend who had started some other companies, because I realized about 3 months in, God, this is really hard work. I'm working every day really hard, every hour. So I asked my friend, is there any way to do this without working that hard? And he very quickly said, no, there's not. So isn't that true, Eric?
That's
right?
true. The good news, I do not think that's a work, because we all enjoy that, right? This is a part of life. Otherwise, what can you do? Are you going to play golf? No. So
there's no shortcut.
Exactly, no shortcut.
All right, everyone, for our final sponsor of the episode, we have another of our favorite companies here at Acquired. This is so fun. Modern Treasury. By this point, probably longtime listeners of Acquired know everything about Modern Treasury, but they are by far the best way to manage your company's payment operations. Their platform allows you as a company and your developers to build right into your product the ability to move money. So you can imagine that is pretty important for probably just about anything your company does or any application or service these days. And you can do it using code, not manual finance operations. It's literally a software layer on top of your bank account that connects with all of your users, customers, partners, everything. They have direct integrations with almost every major commercial bank at this point, and they allow you to move money using APIs and web apps versus managing the complexity of banking rails yourself. I mean, I know, companies, I remember 5-10 years ago, especially marketplaces where you're moving money around, managing all of that complexity themselves was brutal.
You're just building so much software, and then you're thrusting your own internal software onto your finance teams. It's a mess.
Your finance team was doing so much of that manually.
Yeah.
And now Modern Treasury just takes over all of that. It's been incredible to watch this company. They're just a few years old. 2 years ago, right after they started, they were reconciling about $10 million of payments every month, which, that's a lot. About $10 million a month moving on the platform. Today, they are doing well over $2 billion of payments every single month moving on the platform.
And just so folks understand, Modern Treasury is not only the workflow software that gets used by the product team and by the ops team and by the finance team, they're also the literal underlying money movement. So they have bank integrations to actually facilitate those movements for you. So you're not just clicking a button and then you also need to go do something with the bank. No, it is all actually integrated.
It's so great. They are used by companies like Gusto. They're moving a lot of money at Gusto. Marqeta, Revolut, Pipe, TripActions, ClassPass, BlockFi, LedgerX. Lots of crypto companies are now using them for ramps on and off and connections between fiat and crypto and Web3. You can do so many use cases with Modern Treasury: automatic payouts, direct debits, incoming payment reconciliation, digital wallets. So whether you're building a fintech app, if you're building something in fintech, you absolutely need Modern Treasury. You for sure already know about them. But even if you're not in fintech, if you're looking to add payments or any aspect of money and money movement to your software product, Modern Treasury's APIs are super simple. Absolutely go check them out. You can go to moderntreasury.com/acquired to learn more. And when you get in touch with them, just tell them Ben and David sent you.
Thanks, Modern Treasury.
All right, well, we got to wrap, but there's a quick way that we end every Acquired episode, which is with grading. And for companies that are in the middle of their journey, like both of yours, we like to ask it as a little bit of an open-ended question. What makes the future of Zoom and Veeva an A+? What's the scenario where it goes incredibly well? Paint that for us. And what's the failure case?
Oh, let's see. I don't many times thinking about the failure case, honestly. I just not wired that way. A+ is we really help automate this big industry, right? It's a $2 trillion industry. And if we can help to automate it and be that trusted partner that is essential to that industry, and using that word very specifically, essential, and appreciate it. There's not been anything like that before, where you're automating a whole industry in a meaningful way, right? Essential. You're going to be a life sciences company, you got to use Veeva, and man, you like that. So that would be a big success. And then we have a bit of a social mission too, to prove that you can be a good company, profitable, et cetera, but also be a good contributor to society and the employees. So that would be success.
You were the first public company to convert to a B corporation, is that correct?
To a public benefit corporation, but that's just the formality of it. It's, the way we've operated the company is always like that. So that's success. So essential, appreciated, really automating this industry and contributing to a good, being an example of a good employer so that other people could copy it.
Love that.
Yeah, so in our case, I would say that's a good question. A+ scenario would be, Zoom will be a very successful platform company. We are going to introduce multiple new services, and people can count on Zoom to achieve more. At the same time, we can also grow our revenue every year. That's probably A+ scenario for many years to come, right? In terms of a failure scenario, I would say maybe you go back to use WebEx. That's a failure scenario. So, and yeah, Peter, right. And I did not think about the failure scenario, but we just think about be very optimistic, think about the future. Otherwise, seriously, we're all founders, right? The CEOs, we all feel the huge pressure. But sometimes you cannot be, too paranoid. Otherwise, every day you think about too much about a failure case. Guess what? You do not dare to move forward, right? So that's why I say, do not think about that. So next time, do not ask me this question.
So only the paranoid survive, but don't let it consume you.
I think you're paranoid about not doing your best, right? I think, Eric, you put a ton of pressure on yourself. You don't feel good if you don't do your best, right?
Totally.
So I think I see that in Eric.
I love that.
Well,
all right.
Thank you all. Thank you for being here in the room with us. And mostly, thank you to both of you. Thank you to Emergence for facilitating this, making it happen. And,
but thank you, Emergence Capital. Thank you, Sandy. Thank you, all of you. I really appreciate it. Thank you, my great mentor, Peter.
Yeah, thanks
Wonderful.
Thanks
Thank
to
you.
that group.
Thank you.
Thank you. Well done. Thank you, Peter.
All right, listeners. Well, thank you so much for joining us for this. I actually cannot imagine a more useful topic right now than dissecting how to build great companies on little capital based on the era that we're going into. I think, David and I don't need to debate this endlessly. Like, you can hear the drum beats on Twitter of how much the market is changing. But, the reality is it is. And everyone has to play the game on the field. And Peter and Eric have just, it's just unbelievable and impressive what they have built on so little capital.
They're two of the greatest of all time, literally two of the GOATs at this, which is so funny. Now everybody thinks of Zoom as the, pandemic, high flyer. And it's like, I was just thinking every time for the last few years, like, that people would talk about Zoom in whatever context. I'm like, do you people realize how much cash flow this company is generating? And it's all because of, this DNA and mindset and everything we talked about with them.
And after spending time with Eric, I mean, it feels to me like the amount of time that he spends thinking about, oh no, the stock was going crazy, and oh no, now it's going down, is like approximately zero. They're thinking about, how do you build a great company, and how do you generate happiness for customers, build a profitable enterprise, and grow that profitable enterprise. And it was a nice, refreshing viewpoint to get to spend time with him and Peter. Well, if you want to chat about this with us, we would love to do that with you. You should join the Acquired Community Slack at acquired.fm/Slack. 12,000 smart, courteous, and kind people have done so before you, so you would be in great company. We also have our limited partner show. And if you want more Acquired between now and our next special, which we have recorded and is awesome and we are very excited to release, you can search Acquired LP Show in any podcast player, Spotify, Overcast, Apple Podcasts, anywhere you listen to podcasts, and find that there. We have a job board, acquired.fm/jobs, where we curate the most interesting jobs that we think we should make available to the Acquired community. And with that, our huge thank you to the Solana Foundation, to our friends at Mystery. Go check it out. Trymystery.com/acquired, 3 for 1. It's seriously insane. And our friends at Modern Treasury. That's moderntreasury.com/acquired. And we will see you next time.
Wait, but you forgot one. Huge thanks as well to our friends at Emergence for making this possible.
That's so true.
I'm so happy I'm wearing my Emergence Capital fleece right now.
You got to rep the swag with pride.
Got to rep the swag. Seriously, I was thinking as you were saying that, I know we talk about the Slack at the beginning and end of every episode. It really is like, it's not just like, oh, you should join the Slack because you like Acquired. Like, if you're listening to this, you are probably a founder, an employee, an investor, working at companies of any size where this is relevant, and so is everybody else. And people are like, this community is amazing. People are talking about this in Slack. Jake from Emergence is right there in Slack to talk about this. People DM each other. There's so much vibrant discussion. Can't underline it enough. It's such a great part of the Acquired community. And if you're not part of it, you should absolutely join.
That you should. All right, listeners. We'll see you next time.
We'll see you next time.
Who got the truth? Is it you? Is it you? Is it you? Who got the